You ever see this happen? A company drops what looks like great news, and then you watch its stock just completely tank? Well, that's exactly what went down with Target. So in this explainer, we're going to unravel this mystery of why Wall Street hit the sell button right after a supposedly positive earnings report.
Okay, let's dive right into this, because the whole situation is a classic Wall Street head-scratcher. I mean, on the surface, things look pretty darn good for the retailer, but the market's reaction? Whoa. It told a completely different story.
And this gets right to the heart of the paradox. You had headlines everywhere basically screaming, "Target beats expectations." Now usually, that's the kind of news that sends a stock soaring, but instead, it plunged more than 7% almost immediately after the announcement. It was just a massive, jarring disconnect.
So you gotta ask, right? What was hiding in the fine print? What did the professional investors see that made them just ignore the positive headlines and run for the exits? That's what we're gonna figure out, clue by clue. So our first major clue, it actually has less to do with dollars and cents and more to do with who's sitting in the corner office. Turns out, the earnings report wasn't the only big piece of news that dropped that day.
Right, so at the exact same time they released their financial results, Target also dropped a bombshell, a CEO transition. They announced that their chief operating officer, Michael Fiddelke, would be taking the top job in early 2026.
The source material here uses a really specific word, eclipsed. This leadership news didn't just distract from the earnings numbers, it completely overshadowed them. The market's focus instantly snapped from, how did they do last quarter, to, uh-oh, what's going to happen in the future? And here's the real kicker. In their own statement, the board said the new CEO was the right person to return Target to growth. Now, for an investor, that's a massive red flag. It's an admission from the very top that the company isn't actually on a growth path right now, and that sparks some serious concern.
That brings us right to our second clue. And for this one, we have to peel back the layers on the sales numbers. The headline might have said they beat expectations, but the trends hiding underneath tell a much more worrying story.
This is what the investors were looking at. While yeah, Target beat a lowered bar, their comparable sales were still down nearly 2%. Plain and simple, the business is shrinking, not growing.
And that decline is so critical because you have to remember, over 81% of Target's entire business still happens inside their physical stores. Digital is important, sure, but the brick-and-mortar experience, that's the heart of the company.
And that heart is weakening. In-store sales didn't just dip, they fell by over 3%. What that means is fewer people are walking into the stores, and when they do, they're buying less. For a retailer of this size, that is a fundamental core problem.
Now, you might think their online business could save the day, but even that story has a pretty big catch. The growth in their digital sales, which used to be a shining star, has basically been cut in half, dropping from almost 9% down to just over 4%. It's still growth, yeah, but it's slowing way down, and it's nowhere near enough to make up for the decline in their massive store business.
All right, for our third and final clue, we're going to follow the money. We've seen that sales are struggling, but what's actually happening to Target's profits? This is where the story gets even more concerning. Just look at this number. Operating income, that's the profit a company makes from its main business. It plummeted by nearly 20% from last year. That is a dramatic drop, and it shows you the business is getting significantly less profitable.
This table just lays it all out. You can see net sales are basically flat, right? Down just a tiny bit. But then look at the margins. Gross margin, operating income, operating margin, they are all down, and down significantly. The bottom line is, Target is having to spend more just to make less.
So why the big squeeze? Well, it's a mix of things. They're using more discounts just to get products out the door. People are happening to buy more of the low-margin stuff. They're even paying fees to cancel orders for inventory they know won't sell. And when sales dip, all their fixed costs, like store rent, eat up a bigger chunk of the money they do bring in.
So when you put all three of these clues together, a surprise CEO change, declining store sales, and collapsing profits, the market's reaction starts to make perfect sense. This wasn't about one quarter, this was about the direction the entire company is heading.
And this is really the ultimate takeaway. The stock didn't drop because of the past results. It dropped because of what those results implied about the future. Investors saw a company with a new leader who's about to inherit a business that's slowing down and becoming less profitable, and that equals risk.
Now, this whole reaction has pushed Target's valuation into some pretty interesting territory. And to understand this, we need to look at something called the P/E ratio. It's just a simple way of measuring how expensive a stock is compared to its profits. A lower number can mean it's cheap.
This comparison really puts the situation in sharp relief. Right now, Target's P/E is around 11.5.
That is way lower than its 10-year average of over 16. So the question for investors is this. Is this a bargain? A great company on sale? Or is it a trap? A company whose profits are about to fall even further?
This all sets the stage for the massive challenge that's facing Michael Fiddelke when he takes over as CEO. The problems are now crystal clear, and the job ahead for the new leadership is just immense.
His to-do list is basically a summary of everything we've just talked about. He's got to stop the bleeding in the physical stores, he has to figure out how to improve profitability, he needs to get digital sales growing faster again, and maybe most importantly, he's got to convince Wall Street that he has a real plan to do it all.
And that leaves us with the final question. That whole paradox of good news leading to a stock plunge? Well, it was really just the market seeing the deeper issues before everyone else. Now with those issues out in the open and a new leader on the way, the real challenge begins. Can Target solve this puzzle and get its magic back? That really is the billion-dollar question.